Dear ladies and gentlemen, first of all, I would like to thank the organizer of the first International Angola Diamond Conference to invite me as a former CEO of Antwerp Diamond Bank and being for more than 40 years in the industry to walk through the evolution of the diamond financing scene, starting with the traditional financing of so-called diamond banks, evolving towards more structured, like securitizations and asset-based lending by institutional investors and funds. Let's first have a look at the main triggers that, in my opinion, caused the downward trend of the bank finance to the diamond industry. First and main trigger was the worldwide financial crisis in 2008. No doubt, the worldwide financial crisis in 2008 was shaking down the financial system and the global worldwide economy into its foundations. Let's drill down a little bit of the impact of banks financing the diamond industry. Starting with ADB. ADB was established in 1934. In 2002, KBC, one of the biggest Belgian banks, became the 100% shareholder and owner of ADB. ADB was the only bank solely focusing on financing the industry as a separate legal entity, and this for more than 75 years. Head office was in Antwerp, with subsidiaries and rep offices in Singapore, Dubai, Mumbai, Hong Kong, and New York. Other important banks to finance the industry, like ABN AMRO, HSBC, the Indian and Israeli banks, also had diamond divisions integrated in their bigger entity of the bank. Because of the financial crisis, KBC came into trouble and was bailed out by the Belgian and Flemish governments. As a result, KBC was obliged to shrink its balance sheet and activities and had to sell off 25 entities. As ADB was no longer fitting in the revised strategy and the core activities of KBC, ADB was one of these entities. In the end, KBC was not able to sell ADB and decided to wind down all activities of ADB with repayment plans for customers up to maximum 5 years. All financial institutions were heavily impacted and had to review their strategies and redefine their core activities. Moreover, as several banks were bailed out or got other state aid, financing the diamond industry was often no longer seen as a core activity within the bigger framework of those banks. Not long after the announcement of ADB, also HSBC decided to withdraw from financing the diamond industry. In that same time frame, ABN AMRO closed or sold their diamond divisions in New York, Hong Kong, Mumbai, Dubai, with Antwerp remaining the only division left. All other banks, Indian and Israeli banks, also decided to bring down their exposure or perform some arbitrage in their portfolio. At the same time, some Dubai banks like NBF and Emirates NBD prudently came in. Diamond banks were and are still providing working capital to diamond companies in the form of mainly receivable financing and, in a lesser extent, purchase financing. The banks finance transactions like imports, local purchases, sales, and exports. The underlying securitizations were invoices and more paperwork, while the goods, the real underlying collateral, were flying around the globe. Hard collateral and securities only covered a fraction of the granted credit lines. It is no secret that some companies misused and abused the system. also using the finance for non-diamond activities like real estate, financial derivatives, and stock exchange. In combination with, in some cases, and we have to confess that too, two large credit lines granted by banks and the huge impact of the crisis on the non-diamond activities of some companies were leading to important credit losses. These bankruptcies enhanced the perception of the diamond industry being a high-risk industry. Basel. The financial crisis led to the Basel III regulations, with the set of financial reforms that was developed by the Basel Committee, with the aim of strengthening regulations, supervision, and risk management of the banks. Basel III has two main pillars. On the one hand, the increased capital requirements, and on the other hand, the strengthening of the risk management. Let's first have a look at the capital requirements. Banks were obliged to implement minimal capital requirements to create a bigger buffer to absorb shocks during a financial crisis, and as a result was leading to higher capital adequacy and liquidity ratios. Even more important for our industry in this context is the introduction of advanced and more sophisticated risk management systems and risk models. Banks were imposed to rate the credit risk of their credit takers based on benchmarking, objective criteria such as financial criteria, past performance of payments, and subjective criteria such as market and reputational information. As our industry was perceived as a high-risk industry, as a result, banks had to deploy even more capital to finance diamond companies. This, compared to other lower-rated risk industries, was leading to higher interest rates, stricter terms, and more and hard collateral to compensate risk-return ratios and risk-rewards for banks. Needless to mention that corporate governance, compliance, and know your customer policies are high on the agenda from financial institutions, insofar that it is today, in some countries, almost impossible for diamond companies and/or their directors to even open bank accounts. All these aforementioned factors brought the outstanding bank finance, which was estimated around 16 billion in 2013, down to around 7 billion in 2020. All the changes in legislation and Basel III in particular incited investment banks and investment managers to come with alternatives for the working capital bank lending. And so we come to the asset-based securitization programs. Banks could take the lending of their balance sheets and pack assets in the securitization program with a more favorable credit rating. Moreover, in the term sheet, an important number of covenants, conditions, financial and audit requirements, and triggers could be incorporated to secure the underlying asset, and this to better protect the purchaser, the bank, and the insurer against the risk of credit losses. A credit rating and credit insurance could positively impact the pricing of the program. The seller, the underlying diamond company, was of course assured of a longer-term financing and such much easier to manage cash flows and cash management. Moreover, they had a fixed margin above LIBOR for the same period. Negative point is the high setup costs for these programs. The latter, combined with the fact that diamond companies wanting to get access to this kind of financing need to be corporate or near corporate, as the requirements on as well managerial, financial, operational, and compliance are very demanding, resulting in the fact that up till now, only a handful of companies were able to get access to this source of funding. Very recently, a new player came into our industry, a non-bank lending fund granting finance leased on underlying assets limited to rough and polished diamonds. Also high-end and estate jewelry, namely the Delgatto Diamond Finance Fund, the fund that I joined as a director since short after its conception. The Delgatto Diamond Finance Fund, also called DDF, was founded by Chris Delgatto and Andres Lucas in 2018. Chris Delgatto has spent his entire adult life in the diamond industry. His career began in 1987 as a teenage diamond cutter in New York's legendary 47th Street Diamond District. Since then, he has gone on to found and sell a number of companies in our industry, the latest being Circa, which under his leadership was one of the largest buyers of diamonds from the public globally. Widely regarded as one of the most influential entrepreneurs in the diamond and jewelry industry, he identified the need and created the model that delivers alternative credit to companies in all segments of our supply chain, all while commercial banks are rapidly exiting. For a variety of reasons, as I mentioned before, commercial banks no longer have the ability to provide the same level of support that our industry has historically enjoyed. Therefore, the creation of a fund founded by diamond people dedicated to only serve the trade is a critical moment for our industry and one that deserves significant attention. As the largest non-bank lender to the industry, DDFF is the first institutional alternative lender that is interested in working with all parts of the supply chain and companies of all sizes. This is important as other non-bank lenders only target the top few largest companies, excluding junior miners and diggers, as well as the majority of manufacturers and traders. The Delgatto Fund operates as an SEC-registered hedge fund. To be SEC-registered, you need to have assets in excess of 250 million. In addition, DDF manages separate pools of private equity capital. This size has enabled us to allocate over 500 million in the industry already and growing on a monthly basis. Our partners, investors, range from various sovereign wealth funds and US-based pension funds. Quality of our partners not only attests to the soundness of our strategy, but also to our long-term commitment to the industry. Although providing capital on a collateralized basis is our core function, the Delgatto Fund is truly a strategic partner for companies that plug into our ecosystem, because we are not bogged down with the regulatory hurdles of a commercial bank, and we only create personal financing structures that work for each company, and we also provide added value. What can we do, for instance, for diamond miners? We can finance your run of mine immediately, and for junior miners, we can even pile up the goods until they decide to sell or to tender them. For diamond miners, we can also finance your rough immediately and place goods to the tender house of your choice, either in Dubai or in Antwerp, thereby shortening your cash flow cycle dramatically. We can also finance your specials what specials, what we call is rough stones of 8 carat plus and fancy colored stones, and then manufacture these in one of our two wholly owned factories in New York and Dubai. Our factory in Dubai will open up in the beginning of next year. You then reap the benefits of the downstream profit on these special items without the financial burden of holding inventory. For traders and manufacturers, we can finance and process the rough at our state-of-the-art factory in Dubai. Upon completion, you have the option of us handling the certification and even marketing the goods in the US if you wish. As for the miners, we are very interested and open for partnerships on larger stones, being the same, rough being 8 carat up and fancy colors, uh, and to co-invest with you, and we can afterwards polish in our factories if you wish, or if you can polish in your own factories if needed. We can also finance your existing rough or polished inventory, so you can use the capital for other strategic reasons, typically other purchases. We can again help make the market the polished for you as an option. We also have our own high-end retail operations in the US, which is an effective marketing option. We also provide advisory services. All of this is free of charge, and comes with using the Delgatto Diamond Fund. All finance is based on the market value of the diamonds, rough or polished. We understand value, and most importantly, we are comfortable with diamonds as an asset class, something that banks have always struggled with as they did not have the knowledge and the expertise. We have offices in New York, Dubai, and Johannesburg, and we are soon opening in Antwerp and in London. We are well positioned to assist companies wherever in the supply chain. Existing clients are rough producers, miners, junior miners, and traders, manufacturers and polish sellers and traders, jewelry manufacturers and retailers, estate jewelry dealers, and watch dealers. We have financed over 300 companies to date, with over 500 million, as I mentioned before. Although discretion is key for us, many of our clients are some of the most important in the global diamond trade. Contrary to some industry speculation, we are not, and I underline, we are not a lender of last resort. 40% of our requests are denied and declined. We also do not provide capital simply for corporate operations or expenses. We work only with companies that have interesting strategic purchase opportunities, but do not want to or can't take the funds from their regular cash flow. 90% of our financing is used for opportunity purchases that bring healthy margins. We are not interested in companies that make 2% margins. If you are a company that has created opportunities for yourself, and what can help you grow is capital for acquisitions, then we are an alternative for you. Our onboarding process is simple. There is an AML and a KYC form to be filled out, and then discussion with the management will take place on the use of the funds. Important is that the diamond company can prove the ownership of the goods. This process typically takes 2 to 3 business days. Once approved and the collateral value and strategy is planned, a sale buyback agreement between parties will be signed, and you can be funded almost immediately. Conclusion. Um, there will always be bank finance available for diamond companies, whether it will be by regular banking facilities, securitization programs, and or non-bank asset bank lending. Bank lendings have increased in the past and will not go down. On the contrary, while the hassle of providing documents and stringent transaction screening will remain, if not increase. Maybe some banks might review their commitment to the industry and further reduce their outstanding. On the other hand, new investment managers and funds may come in to finance the industry in one or another way. Asset-based securitizations will be available for the major diamond companies with an outstanding corporate governance and corporate or near corporate structures. As well, banking facilities as securitization programs are and will be governed by strict terms and conditions as there are, amongst other, eligibility of counterparties, country and counterparty limits, concentration limits, internal and external audits. In the case of securitization programs, also cash reserves may be required. In the case of the Delgatto finance, none of these are required as we base our finance on the value of the underlying goods. With our presence at this first Angola International Diamond Conference, we would like to demonstrate our support to the Angolan and, by extension, the entire African mining scene by providing you financing of your run of mine, free tender financing, revolving working capital, specials, and value-added financing on a collateral base. If you have any questions or should require additional information in the coming days, please contact me or my colleague, which is also present. He's the director for Africa based in Johannesburg. His name is George Machinini. I thank you for your attention. Obrigado. Thank you.